All right.
Da 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 da. Yeah, da da da.
Always, always, always. Hey everybody, it's Rachel here with your Tech Talk Tuesday for Tuesday, April 4th, 2023. With me as always is our resident expert, David Blake. David, how are you today?
I'm doing well, Rachel. Thank you.
Great, let's jump into it.
Okay, well, Bulls had a good week last week. Equities were sharply higher for a second week, and we kind of saw investors shake off the banking concerns from the previous couple of weeks there. We had some good news over the weekend before that North Carolina-based bank First Citizens was going to buy Silicon Valley Bank. That kind of put a bottom under the banking, the financial sector for a little bit. We did see a nice boost for the financial shares early to start the week, but as they were starting to move up, we did see a little bit of sideways action in the broader market as we saw some clients rotate back out of some of the tech issues. You know, they've had quite a run up the last couple of weeks, so that wasn't to be surprised. You know, they're overweighted in some of the different indexes. So when you have a top 5 or 6 or 7 stocks have a little bit of profit taking, it can you know, mark the QQQs and the NASDAQ, push it down a little bit more than what's really going on, because the underlying breadth was pretty strong despite the sideways action in the NASDAQ. So we had you know, we had a few more solid earnings came out. We did get some Fed officials again that came out, and they had a little bit more of a dovish tone. They were with the banking crisis there. The Feds have kind of backed off a little bit. That's helping the market. We also saw yields kind of back up a little bit, but again, as I don't think the Fed wants to do much in here until we see more play out with what's going on with the banks. You know, we have some officials say we need to get more regulation. The banks don't like that, so that caused them to pull back a little bit. But on Friday, we ended up having the PCE, the Personal Consumption Expenditures Index, came out, and that's the Fed's preferred inflation gauge. And it actually was came in a little bit softer than what the analysts were looking for. So that's good. That kicked off another rally into the weekend, and that also again saw a little bit of a dip in rates in the 2-year and 10-year, which is good for equities going forward here. The gains were pretty much across the board. We had every sector green. Was led by energy, and then the growth sectors, we had consumer discretionary and materials and REITs. They were all up more than 5%. Yields fell down as low as I think the 10-year closed out the week at 348. The 2-year landed at about 404, and that was after dipping to 3.77 the previous week. So the yields did firm up a little bit as the banking turmoil kind of flattened out itself a little bit. So that's good. We'll talk about what rates are doing yesterday and today a little bit. That is a different story. Anyway, the banking woes helped move gold prices higher. Gold was flirting with $2,000 an ounce, and I believe yesterday it finally did cross above $2,000 an ounce. That was the first time for that since August of 2020. So gold still looks like it could possibly go higher here unless we start to see another big pullback in the rates. We'll have to see about that. Crude oil prices were also up last week about 8%. Whether that was because they were expecting to see what happened yesterday or not, I doubt it. But we did see oil yesterday take another spike up. It was up 8% the week before, and then yesterday we saw, I think it was another 6%, as we had kind of a surprise announcement from the OPEC Plus nations that they were going to cut production by 1.6 million barrels a day. That sent oil screaming higher. And then, of course, with any oil-related stocks, like we had Chevron in the Dow, it was up 4.6%. ExxonMobil, Halliburton, all the oil-related stocks jumped yesterday. And in fact, the energy sector, I think yesterday itself was up. Let's see, I think it was up about almost 4% yesterday itself. So a lot of stuff going on with that. I'm not sure that's going to stick. They're trying to keep the oil prices up around 80. We'll have to see how that goes over the next couple of days. So I am expecting a little bit more volatility in the market here. Okay, as far as the technical condition that goes of the different indexes, we did see some improvement last week. And with yesterday, the Dow Jones actually crossed back above its 100-day moving average. So the Dow and S&P and NASDAQ are now trading above their key moving average support resistance levels. So that's a positive. We did see the technical indicators cross into more bullish position. MACD, which is a short-term trend gauge, it had a bullish crossover, and then momentum is measured by the 14-day RSI. It's strong and seems to be increasing until not today, but up until today. And we also saw the small cap Russell 2000. It had a bounce, but it stayed below some of its key moving averages. Let me check just today to see what we're doing here. So they've gotten up to let's see here. It got up to the 200-day moving average almost last week. Yesterday, the Russell 2000 bounced against the 200-day moving average, and today it collapsed with the rest of the indexes, and we're back down below it. In fact, we took out about 3 or 4 days worth of gains from last week with the small cap Russell today. Let's see. As far as we changed our posture to bullish on the MarketEdge market posture. We put new upside targets for the major averages. It looks like the Dow should be able to get to about 34,000, 34,200. The S&P 500, we have 4180 to 4200, and NASDAQ looks like the target could be around 12,600 to 12,620. Underlying breadth was bullish with last week. We had the NYSE and NASDAQ advanced decline lines, which we consider leading indicators of market direction. They were up sharply last week, which is good. It shows the majority of stocks are under accumulation. And then we saw some good contraction in the number of new 52-week highs on both indexes. Now, the NASDAQ continues to put in more new lows and new highs, but again, we're down to about 100 a day on the NASDAQ, but that was up about, I think a couple of weeks ago. We had over 620 new lows. So it's again, we're contracting as we're moving off these lows. Market sentiment, from what we follow, we're seeing more of a neutral position, but retail investors, we still have kind of a 2-to-1 bears to bulls. There was a small uptick in percentage of bulls from the American Association of Individual Investors. And then we saw the hedge funds increase their exposure to equities again. That jumped up to 65% exposure. They're not ringing the bell this time to jump in, but they are, adding to positions in here for a little bit. So we'll see how that goes. Also, the percentage of bullish investment advisors, that firmed up to a neutral 40.8%. So we'll keep an eye on that. Anyway, yesterday we came in and, like I said, we had that big spike in major averages. But today we had 2 pieces of information come out. I talked last night that we're going to have 4 days of jobs data coming out. And this morning we had JOLTS report came out, and JOLTS is the number of job openings. And that fell from 10.6 million last month. I think it's 9.8, maybe 9.2. Let's see here. JOLTS fell, 9.9 million jobs. So that was one of the first indications that we've seen a softening in the labor market. And then we also saw February factory orders. This is kind of a lagging indicator. It was down 0.7% versus 0.5% estimated. So that also was weaker than was expected. Now, we did see rates inch lower, but at the same time, we also saw equities drop today. The Dow was down about 300 points at one point this morning. And what we're going to see is this, I mentioned this about a week or so ago, that we're going to see is bad news or weak numbers is going to be bad news. For a while, we were hoping we were going to see the the initial jobless claims jump up above 200. That was going to be a good sign for the market because it meant that, the things were going along strong. The economy was still strong, but, the Federal Reserve wanted to see a little softer jobs market, and that would have been good for what they wanted to see. But now we're kind of getting into the space where, as we see economic data begin to slow down, we're also starting to see that's also starting to bring down yields, which again is not what you want to see. The reason yields are coming down now is because recession fears are starting to go up, and that's something that we'll have to watch. It'll be more of a balancing when you come in the morning, you see some economic data come out that misses estimates and is maybe a half a point low or something like that. We're probably going to see equities maybe stall a little bit or trade sideways. So it's going to be, I think we'll be okay in here for a little bit, but I think that we're probably still going to be some choppy trading in here for the next couple of weeks. We do have earnings coming out in a few weeks, probably. I think it's like 2 or 3 weeks. We'll start getting the money center banks, and that'll be important to see, how much maybe upside momentum we can muster here.
Great. Well, as you mentioned, the major averages are up for our second week, and we've raised targets. What can keep the upside momentum going in this market going forward, especially given this sort of increased fear of a recession looming?
Well, several things. Part of the market, we've been going sideways, for quite a while. We go up as far as, let me get the S&P up on my stuff. But we pulled back down here in October. We pulled back again in December. We pulled back on the S&P again in mid-March. And what's happening is they keep pricing in a little bit more of recession fears. Every time recession fears begin to increase, you start to see the market pull back. And I think that's what we're going to see here. As far as I don't think first quarter earnings are going to be as bad as some expected. That begins in 2 or 3 weeks. We'll start seeing the money center banks starting to come out. It's important. We have taken out some of the resistance levels on the key moving average levels in here, but I believe that seasonally we are in a strong period for the market. That may not make sense to some, but it's just that ideally the first quarter is over now, and we should start to see some strength. Like I said, I don't think that the earnings are going to be quite as bad as what some were projected a couple of weeks ago. I actually think you may get a little bit surprising. Again, it'll be what's going to happen going forward, and then over the next couple of days, I think it's going to be important for us to go through here and not see too much of a jump in jobs data. We were hoping to see the initial jobless claims jump above 200,000 here for the last couple of weeks. It's been quite a while since we were that high, and that would have been good for the market because that would have been people would look at that and said, okay, well, the economy is good, and we're starting to see more people laid off a little bit. So the Fed should be happy with that, and we can see rates just stay where they are. Well, now, if we start to see more of a spike, and if you watch the news, you're hearing, today McDonald's was laying off a bunch of people, Boeing's laying off a bunch of people. You're seeing a lot of people announce, meta platforms. Everyone's announcing big job layoffs, but they really haven't moved down to the numbers that come out over, monthly yet. We'll get those numbers over the next couple of days. We want to see if that's going to start hitting. But you have to remember, if they start to climb too high, that's just going to also feed the recession fears. If they can kind of come in here and just start showing a gradual increase, I think we'll be okay, and that should be able to have the 2-year, the 10-year yields come on back down. I know today it was kind of surprising because the yield on the the yield on the 2-year actually came all the way down to 3.87 again. It was we were just at 5.07 just a couple of weeks ago. And then on the 10-year note, we've talked a little bit about that we'd like to see it under 3.5. Well, now we're down to 3.35. So that's again, that's people, investors, and thinking that perhaps things are going to slow down a little bit more than what we want to see. And I think it's going to be a little bit tricky here for the next couple of weeks, but I do think we can probably, I think you'll see the market firm up here ahead of earnings. But as far as our cycles go and our CTI and all, they start to turn down again in May. So what we see here over the next couple of weeks, I think we'll see we can see the major indices make a run towards our targets that we talked about a little bit earlier, and those numbers aren't crazy high. We're talking about probably taking out the February high, and then that's going to be right about where we may top out here over the next couple of weeks, and then we'll have to see what happens in the summer. I think this summer we may see the market struggle again for a month or two, and then maybe try to pull back and maybe put in not a new bottom, not a fresh bottom, but at least come back here somewhere around the 3,900 level again. But that's just all speculation at this stage. We'll have to see what happens here over the next couple of weeks as we head into earnings. And then again, if earnings start to show up a little bit weaker than what some are projecting, that could also lead to stocks struggling over summer. But I think for right now, you have something like today where you have a little bit bump in the road. I think we'll be able to absorb that and again start to tick a little bit higher going forward here.
Great, thank you for that. And last week we mentioned that maybe you could provide us some of the sectors that perform better going into a recession, or what investors would look to buy as the economy begins to strengthen.
Yes, let me get in here. Okay, Rich, let's do that for next week. I didn't do my homework. I got kind of tied up here, so.
No worries, that sounds good.
Let me go with that. Because I'm more concerned about what's going to happen here. What we don't want to see is these things fly up here, and all of a sudden we get some numbers coming in here, and we get hammered in the market again, which it doesn't quite look as good as it did a week or so ago. But anyway, let me do that for next week, and I'll make notes of it for today.
Great.
Because I do have some stuff from Blackstone, so they did some studies. Technology sector usually leads out, so he's up like 15%, and I'll get the numbers for all that coming for next week.
Sounds good. All right, David, do you have anything else for our listeners this week?
No, I don't. I apologize. I'm not feeling very good today, so I just wanted to, tell you that.
Sounds good. Thanks so much.
All right.
If you have any questions for David or anyone at the MarketEdge team, feel free to send us an email at support@marketedge.com or shoot us a message in that chat box in the lower right-hand corner of our website. We'd love to hear from you.
Bye.
Bye.